welcome to this week's webinar, The Market Outlook, with me, David Jones, and Aondo Markets. This is a webinar that we do every week at 12:30. If you're watching the recorded version, it was held live on the 24th of May, and like I say, it's one that we do every week. And there's a couple of bits to this webinar. First of all, we do a bit on strategy. So every week we try and cover different aspects of trading strategy, and this week we're going to talk about candlestick patterns. Candlesticks is a whole branch of technical analysis on its own, with some slightly obscure patterns. From the top of my head, upside gap 3 crows is one candlestick pattern. Abandoned baby in an uptrend is another one, but we're going to focus on the simple patterns, and I would suggest maybe the more reliable patterns. So we're going to take a look at engulfing patterns today. We'll take a look at that. So I think that risk warning has been up long enough. So let's just flip over to the trading platform. So this is Aondo's trading platform. This is our Trade Hub, and it's a bit of an odd day today. I think it's a little bit quiet because at 7 o'clock this evening, UK time, we've got the latest release of the US Federal Reserve, the central bank, the minutes from their last meeting. So markets, there's a tendency, I think, for it to sort of mark time ahead of big releases like this. We'll have a quick look at stock markets, then we'll talk about candlestick charts. I'm trying to find the S&P. There we go. It's really weird in stock markets. I think when we were looking at it last week, we'd seen at the beginning of a slide, and then it really accelerated, but it has recovered strongly. Let's just take a look. So a week ago, it was the 17th, wasn't it? So we were, where were we? We were sort of back here. This is the S&P 500. So we'd have been here, where it's fallen off quite heavily back to that old support. And once again, I think it demonstrates the importance of these big levels. So the S&P 500 had fallen back to those May lows. We were doing the webinar around about here-ish. So it was just coming down to it again, and it was a big level to watch. And we did see markets fall off a cliff really after that, plunge quite heavily back to the old lows, the lows before the gap of one of the French presidential elections. I think was it election 2? I can't remember. So we filled that gap, but markets have bounced back incredibly strongly. So I think it does show, I think, the resilience that we have in US stock markets at the moment. But if you wanted to build a bearish argument, once again, it's lost some momentum ahead of these old highs. We had this all through sort of late April and through May so far, of the S&P 500, the broader US stock market, pushing out to fresh highs, fresh all-time highs, which is bullish, but they're not really following through on that, and we're seeing a bit of nerves coming in, maybe ahead of these highs. And you can see it in the RSI. You can see we've talked about the RSI in the past, classic overbought, oversold indicator, and the market, because it bounced back so strongly, the S&P 500 has gone overbought. It's carried on pushing higher, but we do have this bearish divergence where the market's pushing out to fresh highs, loads of divergence on the RSI. So this would normally suggest that we're getting near a top. It means that even though the market in this example is going up, the momentum is really fading. And to show you, this is how it's done it before. So back May the 15th, the S&P hits a high, RSI goes overbought, not surprisingly. The S&P scrapes out to a fresh high, but the RSI makes a lower high. And this was a suggestion that the market was running out of steam. So we're seeing a similar thing happening here. So it's an interesting one, I think, even though the last couple of days it sort of gradually ground its way higher. It's going to be really interesting to see how it performs up here in the sort of the 2400 to sort of 2407 area. Is it going to run out of steam, and are we going to see these lows revisited? So even though I think it's been a bit dull, the US stock markets the last few days, maybe when we get this meeting or this release out of the way this evening, we'll have a bit more of a clue on direction for the S&P 500. But I suppose if you really wanted to go short, then it's you've got a good level in terms of where's your stop going to go, about 10 points higher than where we are now. If it does go back and revisit the lows from last week, there's 50 points on the downside. So I think it's a really interesting market. As usual, I've got a trade on the S&P. I've got an options trade on for June, so I do want the market back down here. But I think if it breaks out to fresh highs again and pushes higher, I think I'd change my opinion. But it's going to be an interesting one to watch up at these levels. But let's talk about candlesticks. So what I'm going to do, I'm going to again demonstrate my terrible drawing abilities, and I'll just here we go. Let's do this one here. I'm just going to flip this on here. So if I'm going to change it to another screen, and let's talk about candlestick patterns. Here we go. Right. So hopefully now you can see like a white sheet of paper there. Can someone just confirm you can see that, and you can see me just scribbling on it, just so I know that's working at your end, so you can see that. And let's talk about how these candlestick patterns work. So a classic candlestick chart or a candlestick, looks like something like that. Let's pretend that's a daily. It's a daily candle, and it's been an up day, so the market's gone up. The open is down there, the close is there. That's the high, that's the low. So it's similar to a bar chart, but with a bar it would look like that. So with a candlestick chart, what we do, we just block in the difference between the open and the close. And then a very simple pattern is an engulfing pattern. And what an engulfing pattern is where you have a market, let's pretend we've got a market that's been trending lower. So a market that's moving lower day by day. So the candlestick's going down. And then you have a day, actually I should draw those in black to signify down days. Then you have a day that does this, or an hour, or whatever sort of time period you're looking at. Classically, candlesticks are for daily charts. So we have a day that does this. So what it does, it engulfs all of the previous day's body. So the bit in the middle, the blocked in bit, gets engulfed by the body of the next day. And this, I think, is pretty reliable. Like anything, it doesn't work all the time. But I think it can be a way of showing that the balance, that the psychology of the market is changing. That we're seeing that the bears, the bulls in this example, coming back in. So it could suggest the trend is ending, and or that downtrend is ending. And an aggressive way of trading this, I'd suggest probably the most obvious way. Technically, you've got to wait for the close. So maybe you buy in the close or you buy the next day, but your stop loss should go under the extreme of the candle. Because if it is going to reverse the market, then the market shouldn't take out that previous low. And then of course, if the market moves higher, we can get the opposite thing happening. So if we have at the top of an uptrend a down candle that engulfs the previous day's body, then that's bearish engulfing. So once again, the most aggressive place I would put a stop would be a seller there and a stop loss up above there, because if it breaks out to new highs, then by definition the pattern hasn't worked. So it's a very simple pattern, just needs a couple of days in this example. But let's take a look at it in the real world, because there have been good examples. You don't need to search through loads of different charts to find this. There's one actually going on at the moment. If I or the last couple of days, let's have a look at euro dollar. I've seen some really big moves in euro dollar, and interestingly, I think I put on Twitter the other day, I think it was the broker FXCM put out some data about which way their clients were positioned. And as is always the case, when you have a strong trend, which way were most clients positioned? They were against it. I think they had 3 times as many people short euro dollar as long euro dollar. So again, people were betting against this trend and getting absolutely clobbered. The euro has moved out in the last couple of days to its best levels since September last year. So we've seen a really strong run in euro dollar. But what we do have, if you really wanted to go short, hopefully if I zoom in a bit more, this is our bearish engulfing pattern. So this is where our trend was happily chugging higher. Then we had yesterday a day, it's maybe not quite what it does, I think near enough, for a real world example, near enough, engulfs the previous day's candle. Okay, so our strategy would be short now. So we're short wherever it is, 111, 111.90-ish, with a stop loss up above here somewhere. That's where our short would go. here. And just to look at some of the examples in the past, let's stick with euro dollar. There was a bearish engulfing candle there. Hopefully you can see that. That's from the 7th of May. So fairly tight range, and then a day that engulfs, and the market did sell off for another 4 days. What else have we got? Have we got any bullish engulfing candles? I mean, this was a pretty big day. So you'd have had a wide stop if you'd have bought straight away afterwards. There may be a better example there, where we have the market sold off for 3 days. Then we have a day that engulfs the previous day's candle, and the market does take off higher. So I think there are plenty of these examples out there. I think dollar Canada was one where I'd seen quite a few. Here we go. So this is the dollar Canadian dollar. So there's a great example down here in April. So the 13th of April, the market sold off for a week, really big down day, and then just as big a reversal the next day. So again, a suggestion that maybe this selling's been overdone. Bearish engulfing up there, and at the moment nothing. You know, it's just selling off. Okay, but hopefully you can see, you know, these patterns. I think they're pretty easy to spot. And when it comes to a trading strategy, if you're going to trade off this pattern, then the obvious place to have your stop loss is at the other side, you know, the other side of the extreme of the pattern. But let's take a look. So let's go back to euro dollar. So euro dollar is interesting because we have rallied so far over the last month or so. But you know, I think there's a real risk in euro dollar that maybe that trend is going to run into some problems up here. You know, we're back to the highs from September, around about 112.80, and then the highs from August last year up there around at 113.40, 113.60 sort of area. So maybe for now at least, you know, the euro run has run far enough. That doesn't necessarily mean I'd be in a hurry to short it just yet. Again, if you were trading off the candlestick, there's an argument for going short and putting a stop above the highs, but maybe we will see it running into a little bit of trouble up here. I think one we looked at last week, which is still interesting, is New Zealand dollar, US dollar. I think we followed this quite a bit in the past, and we had a great trend from September 2015 through to last summer. And if we just plonk this in here, I think the reason it's interesting is because, there we go, the weakness that we've had since February, so for the last 3 months, has brought it back to the trend line. So these are weekly candles that we're looking at here. And I think we were looking at this last week and saying, well, you know, if it's going to bounce from anywhere, then this is the zone where it's going to start bouncing from. And so far we have seen some strength. Let's flip it over to the dailies. You know, for me, the trade here, there we go, there's our long-term view again. I would probably, you know, want my stop still the other side of here. Yeah, so below 68, somewhere below 68. The market's currently trading at 70, so that's a couple of 100 points away. So for me, it's maybe not the ideal place to get in. If you're looking at things like the RSI, then you know, it's also heading towards the overbought zone. So maybe we'll see something of a pullback. So I think maybe the interesting trade here, New Zealand dollar, US dollar, is if we do get it moving back towards sort of 68.40, 68.50, and a bounce again. Maybe that's the lower risk entry point. But I think it remains, you know, a pretty interesting one to watch. The rest of it though is pretty boring at the moment. I think until we get these Fed results out of the way. If we look at pound US dollar, it's come off a little bit over the last 4 days or so, but it's still, you know, it was only a week ago that it pushed out to its best levels since September last year. So I think, you know, for pound US dollar, the bias is still definitely up. Let's flip it over to an hourly chart. There we go. We've got, you know, stacks of support from 127.50 through to 128.40. You know, so for me, if we did see any weakness, you know, maybe 100 points or so, 150 points or so weakness from where we are now, it still looks to be something of a buying opportunity, although it has been a pretty dull last few days. Let's take a look at stock markets. So we did touch, you know, briefly on what's been going on in US stock markets. We've seen plenty of volatility over the last week, but we're back to where we were a week ago. And I think for the S&P, you know, we know the levels to watch. It is going to be those old highs just above 2400, so 2405, 2407, that sort of area. If we look at the Dow, the Dow still has not managed to pass that high. Hang on a second, let me flip it over to a daily that we saw at the beginning of March. There we go. So the Dow high is around about 21,180. So it's up here So 1st of March, and we still, we're still a way away from that. We're still, what are we now? Maybe 200-300 points away from that level. And I think this is really the pivotal area to watch for these US stock markets. They have come a long way since the presidential election, the US presidential election. Maybe it's starting to look a little bit tired. There are concerns about what's going on with the Trump administration, so the disagreement with the FBI. We are seeing maybe some nerves slip into stock markets. So I think we need to see it break out through these highs. Saying that, as we saw over the last week, any weakness gets brought up pretty quickly. So I think if we did see a sizable move lower in US stock markets, on the Dow, 500 points from where we are now, back to this sort of area, 400 points or so, it still looks to be a buying opportunity, but the last couple of days has been just sort of steadily grinding it out. If you look at the DAX, similar sort of picture, so the German 30, this has come off a little bit from the all-time highs. So we saw fresh all-time highs on May the 7th, so trading up to 12,870. Got clobbered with US markets last week, but again, it has been dragged higher. But definitely it does feel at the moment that quite a bit of the momentum has gone out of stock market moves, I think. But there's the DAX. So you could argue, we've had a good trend up, good recovery off these lows, lots of support, 12,570 through to 12,600. So you could, if it drifted off a little bit lower from here, there's an argument to be a buyer looking for a bounce back up to this sort of area. But it has gone, I think, all a little bit dull. And just to wrap up the stock market one, let's have a quick look at the FTSE, which is going to be a similar sort of story. We have seen the FTSE recently move out to fresh all-time highs, trading up above 7,500. It's still hanging around at these levels, but again, just sort of mimicking what's going on in the US, really. All a little bit boring and quiet over the last few days. Let's take a look at commodities, and let's go back. If you take a look at gold, and let's go back and again look at this idea of engulfing patterns. We've seen some good setups, I think, for gold. If we walk back, just yesterday, we had a bearish engulfing in gold. So we had the market had been trending higher for the last week, pushed out to what's that high? 1265, dropped back a bit, pushed up again to 1263. So it didn't quite take out that high. So again, I think for the short-term traders, there's maybe a setup there that it was maybe running out of steam. And then sold off yesterday, and we had this engulfing pattern. So again, the trade would be, if you wanted to be short in the short term, going short with the stop above those highs at 1265. Bullish engulfing pattern back there. Hopefully you can see that. So that would have been the 11th of May. So the market was dropping. Then we had a day where it reversed, and that's a trade that would have worked well if we were buying the next day. So if we were buying the next day's open at 1225. A stop loss either under the low of the pattern, but I would probably prefer a stop loss under that low there a couple of days before. So a stop loss at 1214, so a buyer at 1225. Let's say a stop loss at 1210, so a $15 stop loss, and the market did move about $40 higher from that level. So that was a trade that worked pretty well. Bearish engulfing up there, so you can see the market was going up, and a candle that flipped the other way. And nothing much else, I don't think. A bit of bearish engulfing there as well. So I think these patterns, these candlestick patterns, they're pretty easy to spot, and they don't work all the time, but they do give you a sensible place to put your stop loss and manage the risk if you think the pattern's going to play out. So I think in gold, we've still got even though the trend in gold has been broken, if we're going to draw our trend like that, it has fallen out of that trend. I still think, well, the trend is still up. We still have higher lows and higher highs. What we really need now, though, to confirm this trend is still valid, is a breakout through this old high. So a move above $1,300. So I think we may have to wait a bit for it to get back up there. But I think for me, the medium-term outlook for gold is still a push back up to last year's highs, around about $1,370 an ounce. And if we did see much of a sell-off from here, if we see a sell-off back to this sort of area, it looks like a buying opportunity again. Clearly wait for the weakness to run out of steam. But I think if we sort of drop back to here, it looks like another buying opportunity with maybe stops below here. And I think for me, it's only if we lose this old low from March does it really throw into question this recovery that's been going on since December. So I think it's still, for me, it's still bullish. I think the outlook for gold is still bullish. And let's take a look, just to wrap things up, the price of oil. Have I got US oil on here? I've got Brent crude oil. Let's have a look at Brent. Because again, it's been a volatile few weeks for oil, but you know, we've bounced back. We've bounced back from below 50 for the UK version of the oil price, the Brent crude oil, you know, back to 54. It's been a real problem up here, you know, running from 58 to 56. At the moment, it's still strong, but I think even though for me the recovery from last year is still intact in oil, we've clearly lost quite a bit of momentum this year, so it wouldn't be surprising to see it maybe push up to here, run out of steam again. It's getting near overbought on the RSI. We had the overbought back then, that didn't do such a bad job, and also there as well. That was maybe a little bit early. We had the bearish divergence set up after that. So maybe there's a scope for it to push a little bit higher, you know, but clearly the sort of the mid 50s to approaching 60 has been a real problem for the price of oil. But if it drops back again below 50, it looks like another buying opportunity. But it is, I think, definitely more of a range-bound market at the moment than anything else. So what's to watch in the next few days? I think that the big thing to watch for me, US stock markets. I think we're gonna have a quiet session this afternoon. We've got those Fed minutes at 7. Maybe there'll be something in those Federal Reserve minutes that makes the market wake up one way or the other. But I think we need, you know, the US stock markets, they are clearly still bullish. They bounced back really sharply off those lows, but they need to break through those recent highs to kick off the next trend higher. Plus, so there's the S&P. So we're currently trading at 23.98, so about 8 points below those lows. And euro dollar, I think euro dollar, again, you know, it wouldn't be surprising to see currencies move on these Fed minutes this evening. We've had a cracking run up over the last couple of months. Let's see what happens. We did have a bearish engulfing yesterday. Is this going to be the end of the trend for now in euro dollar? So I think that's an interesting one to watch. So someone's just said, when you say buy above, sell below, are you including the wick or just the main body of the candle? Good question. I am including the wick. So for me, if I was going to go short on this euro dollar signal with a stop loss above, I want a stop loss above the extreme. So for me, the open and the close bit, well, it's the open and the close that sets up the pattern. If I'm going to have a stop loss, I want it up here somewhere. Yeah, so I'm not going to set it there because that's, for me, that's a nothing level. So I'd want to see, if I was going short here, if it breaks out to new highs, I'm going to close the short. And the same down here, you know, if we were buying, there's a bullish engulfing down here. So if we were buying here, I would want my stop loss underneath the extreme. So which can often mean a somewhat wider stop loss than maybe some are happy with. But again, if we're looking for a bigger move, I'm quite happy to have the wider stop loss. Of course, if you look on hourly charts, you'll see, so this is an hourly chart now. Let's see if we've got any engulfing patterns here, you know, because even though from a textbook point of view, engulfing patterns, you know, originated on daily charts, and there's no reason why you can't spot them. Like here, this is euro dollar again, 11 o'clock, 12 o'clock yesterday. So on the hourly chart, this is a bearish engulfing on euro dollar. So if we were trading this, if we should have been patient and wait for the hour to finish, so we would have gone short here. So go short at 12 o'clock yesterday, and that would have been, what's that, 112.38, we'd have been short. So our stop loss should have gone, for me, my stop loss would have gone above here. So above the absolute extreme there. But if you're taking off the previous candle, you take it off the high there, so 112.60. So if my stop loss had been above there, that's 112.68. It's only a few points higher. So let's say a stop loss at 75 and short at 38. So a 40-point stop loss there. So looking for, and how far has the market sold off? It's sold off a bit, hasn't it? Sold off 50, 60 points from that level. So there's an example of an engulfing candlestick on an hourly chart. But yeah, I would always have my stop loss past the extremes. Okay, so does that include the entry point if the candle has a wick? I'm not sure what you mean by that question. Let's have a look. If we zoom in, so for me, I'm guessing my entry point here. If the engulfing pattern has happened, my entry point is the open of the next candle. So you technically wait for the hour candle to finish, confirm the pattern, and then just go short on the next available price. So I hope that helps. So that's candlesticks. And I think they're well worth looking at. I think you can tie yourself in knots. Like I said, there's a whole book that came out in the 90s that really kicked off interest in candlestick charting, because it dates back, I think, to the 1600s, to Japanese rice traders. And there's a book called Candlestick Charting, surprisingly, that's written by a guy called Steve Nison. It's Nison. So he's the chap who reintroduced candlestick charting to the Western world. And in there are, you know, some really obscure patterns. And I think maybe one of the problems of candlestick devotees is they try and assign a relevance to every possible combination of candlestick patterns, and I think that's maybe taking things a bit too far. You know, I'm all in favor of keeping it simple. So for me, just looking for these obvious engulfing patterns, you know, particularly if you see on a daily chart, having a sensible place to put your stop, and then just placing the trade. You know, it can be, I think, a half decent indicator that the sentiment is starting to change, starting to turn around. So for those of us who occasionally do like to try and pick turning points in the markets, you know, pick maybe shorter term tops and bottoms, it can be a good way of spotting these things. We're going to wrap things up there as usual, but if you have any questions after, drop me an email. The best email address for me is david@tradeafter.com. Aondo are maybe better known for social trading, copy trading, where you can follow other traders, and I've been blogging about a live account now that's up. I think it's up about 5%, 5.5% since I started doing it back in March, or February, sorry, mid-Feb. So you can read about that, the progress there, and how that all works on tradeafter.com. You can follow me on Twitter for updates if big levels are getting tested. And if I spot any engulfing patterns, I'll put them up on Twitter over the next week. And on Twitter, I'm @JonesTheMarkets. But we will wrap things up there. I hope you find it useful. It's going to be a quiet afternoon, I think. Like I said, let's get these Fed minutes out of the way tonight. We could see a bit of volatility at 7 o'clock tonight when those things come out, and then maybe a bit more of a normal market after that. But I think US stock markets are the ones to watch to see how they perform. Now we're back up near these all-time highs from just the other week. Okay, we'll wrap things up there. Hopefully you can make it again. We'll do it all again this time next week. But until then, I hope you have a good trading week.